What I'm going to talk about in this video is how the cash value works in a whole life insurance policy. We'll talk about how you can build the cash value with money you pay into the policy, and then also how the cash value grows regarding interest that is paid to you from the insurance company. So let's start with you. Here we go. This is you. You're going to get a whole life insurance policy. And a big reason why you are interested in this policy is because of the cash value. So your question is, if I'm going to put money into this life insurance policy, how do I get the most cash value possible? Because this is the main reason why. A lot of times we hear someone say, I want this life insurance policy, but I don't care about the life insurance. I'm really interested in the cash value. So step one is making sure that when you put any amount of money into the policy, the cash value is the priority and not the death benefit. So when you pay money into a policy, let's say you're going to pay $1 into a whole life insurance policy, and you say, I would like cash value, please. Well, when you pay money in, you can choose where that money goes. It can go toward one of two areas. The first area is called the insurance premium. But the next, I have what is called my paid up additions rider. We're just going to write PUA rider. If you would like these terms simplified, here's what I would do. Let's call the premium the initial insurance expense. And let's call the PUA rider a cash dump in. Cash dump. And you'll see exactly why. So let's do this actually, just to make this a little bit cleaner. Okay, so again, you're going to pay $1 in, and your dollar can go toward one of these two areas. Where should you put it? And this is how you build cash value. This is very important to be aware of, because if you say to a life insurance agent or an insurance company, hey, I'd like a life insurance policy prioritized for cash value, you won't always see them go through this, because an insurance company is going to make their most profit on what you see in red, the premium dollars. And the same is true of an agent in the business. The most profit is paid on the premium piece. And here's why I mention that. If you pay that dollar into the insurance premium, so $1 into the premium, what you will find is the first year, you won't see anything show up in cash value. So you'll have $0 there. Sometimes it's the first and second year. Now, as you continue to pay a premium, eventually you see it show up in cash value, typically beginning the third year. I'll pull up an example in a minute. However, I get nothing in cash value, and the reason why is because how the life insurance policy works is the insurance company is going to overcharge me for the cost of insurance up front. That might give me $50 in life insurance. The amount's going to vary a lot depending on my age, the company, and product that I select. But just simplifying this, if you put $1 into the premium, it does not give you cash value initially, but it gives you a lot of life insurance. Make sense? All right. Next, money you pay into that paid up additions rider, the cash dump in. Why I call it a cash dump in is because money you pay here is dumped into cash value. Now, if you paid $1 here, you would not see that full dollar show up in cash value in the first year. Usually, you'll see somewhere between 90 and 95 cents of the dollar in the first year cash value, but that does begin to earn interest, it compounds, and you'll see typically by the next year, the earnings that you received on that dollar in terms of dividends and interest from the insurance company comes back to you, and it makes up for the cost. I'll pull up an example in a minute. But dollars you pay here show up in cash value. You can access it So if you said, hey, I need my money or I want my money here, can I do it? The answer is yes. It begins to earn the guaranteed interest rate that's paid by an insurance company, and you also begin to earn dividends. Make sense? Now, dollars that I pay into the PUA rider are going to buy me some death benefit. It's not going to be as much as the premium gets me. It might be $3 in life insurance. Why people typically put money into the PUA rider is because of the cash value. That's what they're interested in. So the name of the game when I am trying to build the cash value is really lowering the premium as much as the insurance company will allow, and then putting as much money as I can toward that PUA rider. If I do that, I'll see the maximum cash value up front, and then I'll typically see the maximum cash value long term, especially based on the guaranteed values, and in most cases, based on the non-guaranteed values as well. Let's look at a quick example of this. I think this will be pretty cool. This is based on someone that we recently put a model together for. First, we'll look at an example of him putting everything into the insurance premium. So he's paying $2,500 per month. You can see the first year he pays that $2,500 or 30 grand per year is what it comes out to. And he has a little bit more than zero, but not that much, a $29,000 loss in the first year. So he continues to pay the premium. Beginning the second year, he gets most of it back, but he's got to make up for that first year. And when you look at this guy, it takes between 12 and 13 years just to get his money back. We're not talking about any type of gain or return there. Now, he has a healthy amount of life insurance, but if he's interested in the cash value, this is not a very attractive option. So then what we can do is look at the same product with the exact same company and just change where the money is going. So his out-of-pocket is exactly the same, $30K per year or $2,500 per month. His minimum is $3,000 per year. That's what he's committed to. So he can pay just this. Then this column in purple, there's that paid up additions rider. That's optional. So he does not have to pay this. This is showing what things look like if he does pay this, because he says, here's how much I want to add into this policy. Show me what it looks like if my goal is cash value. So instead of $1,000 in the first year, he's got just about $26,000. So it's about a $4K loss in year one. What takes the biggest bite out of the first year cash value is that premium. We also have what's called a term insurance rider attached here. That's a couple $100. And then there is a fee percentage on the PUA piece as well. But if we do it this way, what you'll see is beginning the second year, I'm getting more back than what I pay in. And you can tell because the first year you're at 25.8, you add 30 to 25.8. What would that come out to? Well, 25.8 plus 30 would be 55.8. However, you're at 56.2. So what that means is you got your 30K back and a little bit more on top of it. And then it gets stronger and stronger each year. You break even just about year 4. So again, with the same company and same product, just redirecting where our money's going, we've got a lot more money in cash value. The column on the right just shows how much more you have with this option compared to this option. It's pretty interesting, isn't it, when you look at what you can do with a life insurance policy? So the key is, again, maximizing that PUA rider. And if we were to look at the top life insurance companies, there's a lot of life insurance companies, but you'll have what are called your 4 major mutuals, which we've seen deliver the highest cash values to policyholders. Mass Mutual, Guardian, New York Life, and Northwestern Mutual. A lot of times we can set that minimum premium as low as 10% with those options. Kind of like that example you just saw. So for that guy who was paying in 30K per year, the premium was $3,000. So we shrunk it down in order to beef up the cash value. So with you paying money in, This is how you get the most cash value. The second step, what about money that I get from the insurance company? How do dividends work? This question comes up a lot. So you'll typically see a dividend rate with a life insurance company. And with the top guys and most companies, you can Google search that. So if you take a company like New York Life, most people have heard of them, Google search New York Life 2024 dividend rate, and you'll see a dividend rate of 6% this year. So if you have a dividend rate of 6%, does that mean you're getting 6% interest on your money? It does not. The reason why is because the dividend is considered a gross rate. Think of it this way. If you're the insurance company, you're going to have a dividend rate that you are going to distribute to your policy holders, everyone that has a policy with your life insurance company. However, you're saying, wait a minute, we still have to pay out the death benefit when they die. There is a cost to carry that death benefit. So the dividend is applied to each policyholder's life insurance policy after you account for the cost of insurance. So you'll always have that life insurance expense with the policy. In short, a dividend rate of 6% might give you a net return of somewhere between 4 and 5%. And that's with a cash value life insurance policy. The core benefits to the cash value are safety, liquidity, and then also if we follow IRS rules, it's completely tax-free. So a lot of people like it for that reason. But back to the dividend rate, how do I actually get money applied to my cash value? So the dividend is broken down actually between the guaranteed portion. I'm going to do this over here. That's the guaranteed interest rate. And then you've got the surplus. We'll call that surplus rate. And when you look at a life insurance illustration, you'll see a column that's called annual dividend. That reflects the surplus, not the actual dividend rate. I know it's very confusing, but here's how it works. So if you have a company that has a dividend rate, when you Google search it, of 6%, and your product has a guaranteed rate, let's say of 3%, what that means is the surplus rate is 3% too. So the guaranteed portion is different than the surplus portion. I know that can be confusing, but main takeaway is when you look at your life insurance policy and the company says to you, you received a dividend of $5,000 this year, what I would want to be aware of is that that dividend on that statement does not include the guaranteed rate. The guaranteed portion is separate. Now, if you ask, where do I see that? The answer is you won't see it from the insurance company. You won't see it on the annual statement, on the online portal. It drives me nuts, and it drives a lot of people nuts. So one of the things you can do, and this is what I like to do, if you say, okay, how do I just see my bottom line? Like, what did my money actually grow by this year? That's what I'm interested in. I would look at last year's cash value. Last year, cash value. This year, how much you paid, so money going in. And then this year, what the cash value will be at the end of the year. Cash value, end of year. And what you can do here, I would take this year, CV, that's the end of year cash value, minus last year's cash value minus the amount you paid, and that'll give you the net dollar amount that the policy grew by. Want to see an example of that? Let's take a look. So what I would do here, let's take the good policy, the good one, and we'll do this. And get rid of that column. And let's just call this column cash value growth. All right, so CV growth, and what we do, first year, whatever your cash value is, minus your payment, negative $4,000. Always highlight the drawbacks, that's so important. So let's put that in red. Second year, I would do equals end of year cash value for year 2 minus what your cash value was in the first year, and you'll always see this on your annual statement. If you don't have a copy of your annual statement, you can usually download it on your online portal with most companies, or your agent can obtain it from the company. But the end of year cash value minus last year's minus the total amount you paid. And you can do this with a projection too, like an in-force illustration, we can get this. But year two, I see what my net cash value growth is now. The dividend might show less than that, might show more than that. I kind of throw the dividend out the window. For the most part, the dividend's always going to be less than this number. Sometimes the dividend's higher in year 2, which can really confuse people. But if I just want the bottom line, I would look at exactly this, because this simply shows what your cash value is growing by net year over year. Like, that's typically what people want to know. And you can plug in an interest rate too. We can calculate this if you prefer returns, but I can simply see, all right, with the dividend and interest, like, how does it work? What did I actually receive from the insurance company? And that's what I would do there. I look at it year over year, and again, it's backing out my payment too, because I don't want to include that in my growth. So back to the whiteboard. That's how you calculate your net cash value growth. The last thing I want to hit on here, because this question does come up, is when I receive a dividend, because on your annual statement in your online account, you're going to see your dividend received for every policy year, except for the first year, because dividends usually are not paid in year 1. But if you get a dividend, call it of $5,000, how does that actually work? Well, you can elect several different options for dividends. The most efficient option is to have your dividends purchase paid up additions. And this works identical to what it would look like if you just added money to paid up additions. Remember that cash dump in? So if you have a $5,000 dividend that purchases paid up additions, some companies will use the term dividends are reinvested into PUAs. Doesn't matter, purchase PUAs, reinvested into PUAs means the exact same thing. That $5,000 dividend payment would go to your cash value, which is nice. That would then continue to receive dividends along with your entire bucket of cash value, so it's compounding. But then also, it purchases you more paid up additional life insurance, more death benefit. Remember up here where we said if you put $1 in, it gives you $3 in life insurance. So if you have a $5,000 dividend, you see your cash value go up by $5,000. Also, what you see is, call it, another $15,000 in additional whole life death benefit. So if you die, a larger amount is paid to your beneficiaries, which is good to be aware of with respect to how dividends work. I know sometimes when we see dividends purchase or buy us paid up additions, we think it's buying me more life insurance. Some people say, I don't want that. I want it all to go toward my cash value. It does. So when I elect that option for it to purchase PUAs, that's actually going into cash value. One company, Guardian, on their on their annual statements does use the terminology dividends are reinvested, right? Just to create that clarity. They're reinvested in cash value, and they also purchase you additional whole life death benefit if I had that option selected, paid up additions. Anyway, I hope that this helps. Let us know your thoughts, and if you have any questions at all, and thanks so much for watching. We'll talk to you soon.